All right, so I just got done doing a video on a financial advisor was saying that I was wrong in how calculating provisional income is. And this is just nuts, and I just chuckle. All right, so if you're a financial client of a financial advisor, or you're interviewing financial advisors, and I get this question a lot, like what are some of the questions you should say? The first one, as you're talking, a good question would be, hey, I got $60,000 of income. And you know what, so that way he can get a gauge of what this guy thinks will be your taxes. So let's just say I'm talking to a financial advisor, Josh. I'm the financial advisor. Joan, you're the lady coming in to interview me. And she goes, look, I got $1 million portfolio. I have $60,000 of income. What do you think? And from a tax perspective, how can I best maximize my taxes relative to my $1 million portfolio? And if the financial advisor goes down the road of looking at either you're a single, let's just say a single taxpayer for this case, you'd be in the 24% tax bracket. If the financial advisor says very simply, oh, you have an effective tax rate of 24% on $60,000, please do yourself a favor, do me a favor, do the industry a favor by getting the hell out of that guy's office. It's nuts. If he doesn't ask you, from where that money comes from, is derived from, he doesn't know what the hell he's talking about. I'm sorry. It's nuts. To say you have $60,000 of income and assuming you have an effective tax bracket based on what he perceives as your marginal tax bracket, it's dumb. It's bad planning, and it shouldn't be tolerated by a financial advisor. Because the reason for that is it depends on where your income comes from. All right, let's say $40,000 is from Social Security and $20,000 is from qualified dividends. You have no taxes, none whatsoever. Say $30,000 is from Social Security and $30,000 from Social Security and $20,000 from IRA distributions, or $30,000 from IRA distributions. You're still not in the 24% tax bracket. You're not. You have to. It's called marginal tax rate for a reason. So you have to figure out provisional income. You got to figure out how your taxes are from where the taxes are derived relative to Social Security, other sources of income. Let's say you have $30,000 of Social Security and $30,000 of tax-exempt interest. Well, how much is your tax there? Again, if we're using a marginal tax rate of 24%, that'd be wrong, because your $30,000 tax-exempt interest doesn't flow to your AGI, but it certainly does when it comes to how much of your Social Security is taxed. So all this stuff is contingent on so many things, man. And if you don't know it, and he's giving you tax advice based on ignorance, you can't do that. And so that's what I say to you. I say, look, if I'm talking to a financial advisor and we're having a discussion about taxes, and he's just quoting me verbatim a marginal tax rate based on what he perceives as my tax bracket because of my income, that's not, no. But man, look, I used to do that myself. Oh, you got $60,000 of income, you're single, so you're in a 24% tax bracket, or 22% tax bracket, excuse me, 22% tax bracket. That's not the right answer. You gotta say, no, my tax bracket is based on my taxable income. You got to figure out what my taxable income is. How do you figure out my taxable income? We got to look at it relative to where my income is coming from. And if you don't do that, you're not a good financial advisor. That's all there is to it. So as you're looking at financial advisors, looking at achieving financial advice from somebody, and you start talking taxes, make sure, please, for the love of all that is good in this world, make sure that he understands or she understands how your taxes are derived. And if they don't, and they don't ask questions, you got to get out of there ASAP. All right, we'll see you.